surging global oil prices are fueling inflation in South Korea, with consumer prices rising 2.2% in March, driven largely by petroleum costs. Let's take a closer look at what's behind the increase.
South Korea's consumer price growth accelerated to 2.2% in March, driven almost entirely by a massive spike in global oil prices. According to the Ministry of Data and Statistics on Thursday, the overall inflation rate was heavily pressured by the energy sector. Petroleum product prices surged 9.9% from a year ago, marking the fastest rise since October 2022, when oil prices rose during the war in Ukraine.
The biggest factor is the rise in global oil prices due to the situation in the Middle East. Dubai crude soared to $128 in March from $68.04 the month before. This seems to have significantly driven up our domestic fuel costs.
This near 10% jump in petroleum prices marks a sharp reversal from the previous month. In February, fuel prices had actually declined by 2.4% on year. But with food prices going up, the overall index was around the same level at 2.0%. Now, for this month, breaking down the energy shock, the impact was most severe in diesel. Diesel prices jumped 17% due to its broad use across industrial, transport, and military sectors, while gasoline rose 8%. Despite this severe external shock, the headline inflation rate was kept from spiraling further. The government's price ceilings on fuel products effectively mitigated the spike, keeping South Korea's figures lower than those of other major economies. The energy price surge was also offset by a decline in food costs, a reversal of the factors from the previous month. Overall, agricultural, livestock, and fishery prices fell 0.6%. The fresh food index saw a steeper drop of 6.6% as warmer spring weather boosted crop production. Additionally, processed food inflation slowed following factory price cuts for staple ingredients like flour and sugar. Looking ahead, the ministry warns that upward pressure is expected to persist in April as higher energy costs will inevitably reflect in international airfare and imported agricultural goods. Kim Do-yeon, 아리랑뉴스.
And now our economics correspondent Kim Do-yeon joins us in the studio to discuss this further. Welcome, Do-yeon.
Good to be here.
Right, so you mentioned earlier that the price hike of petroleum products was contained by the government's price cap. So how is Korea faring compared to other nations?
Right, Sujin, the Ministry of Data and Statistics emphasized that the domestic fuel price surge was contained thanks to the government's price ceiling, like we talked about, which is currently capped at 1,934 won per liter for gasoline when it's being transferred to retailers by the refiners.
While we are the first to release detailed March figures, looking broadly, the margin of increase is significantly slower compared to countries like the US or Japan. This effect appears to be largely due to the implementation of the price ceiling.
To be specific, the U.S. national average for regular gasoline just topped $4 a gallon for the first time in nearly 4 years, according to AAA, jumping over $8 per gallon since the conflict began. U.S. diesel has also surged by roughly $1.70. Again, officials confirm the domestic price ceilings prevented a similar steep spike here.
I see, and the Middle East conflict is obviously on everyone's mind right now. So will we see global oil prices stabilizing anytime soon?
Well, the outlook looks grim. Now, a new report by the Korea Institute for International Economic Policy, or KIEP, concludes that oil prices will not return to pre-war levels under any foreseeable scenario.
For example, even in an early ceasefire scenario, it would be $90 by the fourth quarter of 2027. The biggest reason is that supply cannot be rapidly increased. Even if the U.S. eases sanctions on Russia or tries to increase its own production, practically, it is difficult to sharply increase output in a short period.
If the current blockade of the Strait of Hormuz continues, prices could stabilize at a much higher $117. Repairing damaged Middle Eastern energy facilities will take 3 to 5 years. And even if the strait reopens, potential Iranian transit fees will likely be passed down to consumers.
That does sound quite concerning. So what will prices look like in April and beyond? And are there any other areas other than airfare and groceries that will be impacted?
It goes much deeper. Now, as I said before, while consumers will feel the immediate pinch in airfares and imported food this month, a massive crisis is brewing in our core industries. The conflict has severely disrupted the supply of naphtha and LNG. Following the attack on Qatar's gas complex, global naphtha prices have skyrocketed by nearly 50%. South Korea relies on the Middle East for over 34% of its naphtha, the absolute backbone of the nation's petrochemical industry. Furthermore, Qatar is a major producer of helium, a critical component for semiconductor manufacturing. This energy shock is transforming into a severe supply chain crisis for the nation's biggest export players.
All right, thank you so much for coming in today, Toyon.
Anytime, Sujin.